There is a tax in Canada that almost nobody talks about. It does not have a scary name. It does not show up as a line on your tax return that jumps out at you. It quietly reduces your old age security payment, sometimes all the way to zero, and the vast majority of Canadian seniors who are affected by it have no idea it is happening or why. It is called the OAS recovery tax. Most people call it the OAS clawback. And if your retirement income crosses a certain threshold, the government starts taking back the OAS pension you spent decades paying into. In this video, I'm going to tell you exactly how it works, who it affects, how much it can cost you, and, most importantly, the legal strategies that the top financial planners in Canada use to reduce or eliminate it entirely. Because here is the thing, this clawback is not inevitable. For many of the people it affects, it is entirely avoidable with the right planning. And the reason most seniors do not avoid it is simply because they did not know they could. My name is Donovan. This channel exists to give Canadian seniors the financial information they actually need, in plain language, with real numbers. Let us get into it. First, let us understand exactly what the OAS clawback is and how it works. Old age security is the monthly pension the Canadian government pays to most Canadians 65 and older. As of 2025, the maximum monthly OAS payment is around $718 for seniors aged 65 to 74, and just under $800 for those 75 and older. That adds up to roughly $8,000 to $9,000 a year. Now, the government decided long ago that this benefit should be income tested at the upper end. Meaning, if your income is above a certain level, you start paying some of it back. For 2025, the clawback kicks in when your net world income exceeds approximately $90,000. Once you cross that line, you repay 15 cents of OAS for every dollar of income above the threshold. If your income reaches approximately $148,000, your OAS is reduced to zero entirely. So if you earn, say, $110,000 in a year, you are $20,000 over the threshold. 15% of $20,000 is $3,000. That is $3,000 of OAS you paid into all your working life, gone, quietly deducted from your monthly payments the following year. And here is where it gets frustrating. The government calculates the clawback based on your previous year's tax return. So the reduction shows up in your OAS payments starting in July based on what you earned 12 months ago. By the time most people notice something is wrong with their payment amount, they have already lost months of income. Now, who does this actually affect? On the surface, $90,000 sounds like a lot. And for seniors living on CPP and OAS alone, the clawback is not relevant. But for the significant number of Canadian retirees who have pensions, RRIF withdrawals, rental income, investment income, or part-time work, the number can be closer than it looks. And here is the trap that catches people who never expected to be in this situation. When you turn 71, the government requires you to start taking mandatory minimum withdrawals from your RRIF. Those withdrawals are fully taxable income. And for many Canadians who spent decades saving diligently in their RRSPs, those mandatory withdrawals can be significant, large enough to push their total income above the clawback threshold, even though their actual lifestyle spending has not changed at all. In other words, your RRSP was so successful that it is now creating a tax problem in retirement. The better you saved, the harder the clawback can hit. So what do you do about it? There are 5 strategies, and the most powerful one is also the one that almost nobody acts on early enough. Strategy 1 is RRSP and RRIF drawdown optimization. The single most effective way to reduce OAS clawback risk is to manage the size of your RRIF before mandatory withdrawals begin. If you retire at 65 and do not yet have to take mandatory withdrawals, you have a window from 65 to 71 where your income may be at its lowest point. This is the window where smart Canadians voluntarily withdraw from their RRSP or RRIF, pay tax at a lower rate now, and move that money into their TFSA. Yes, you are paying some tax voluntarily, but you are paying it at a lower marginal rate than you would in your 70s when mandatory withdrawals kick in and potentially push you above the clawback threshold. You are trading a smaller tax bill now for a much bigger problem avoided later. Every dollar you move out of your RIF and into your TFSA before 71 is a dollar that will never show up as taxable income again. And a smaller RRIF means smaller mandatory withdrawals, which means lower income, which means your OAS stays intact. Strategy 2 is pension income splitting. If you are married or in a common law partnership and one of you has significantly more pension or RRIF income than the other, you can split up to 50% of eligible pension income between you for tax purposes. This does two things. It may lower the higher income spouse below the clawback threshold, and it may reduce the overall household tax rate at the same time. Two wins from a single strategy. Many couples do not do this because they do not know they can, or because they assume their accountant is handling it automatically. Check your last tax return. If you are not seeing pension income splitting applied, and one of you is close to the clawback threshold, this is a conversation to have immediately. Strategy 3 is maximizing your TFSA. This one is simple but powerful. Income earned inside a TFSA, interest, dividends, capital gains, does not count as income for clawback purposes. It is completely invisible to the OAS calculation. If you have non-registered investments generating interest or dividends that are pushing your income above the threshold, moving those investments inside a TFSA eliminates their impact on your clawback calculation entirely. Check your TFSA contribution room. If you have been a Canadian resident since 2009 and have never maximized your contributions, you may have tens of thousands of dollars of room available right now. That is tens of thousands of dollars worth of income you could shelter completely from the clawback. Strategy 4 is charitable giving through ARRIF, the Qualified Charitable Distribution Approach. If you are charitably inclined and have ARRIF, donating securities or using a direct charitable approach can reduce your taxable income. In some structures, gifting appreciated securities rather than cash means you eliminate the capital gains on those securities while also generating a donation receipt. Lower taxable income means less exposure to the clawback threshold. Strategy 5 is timing capital gains strategically. If you have a non-registered investment account with securities that have appreciated significantly, selling them all in 1 year can create a large capital gain that temporarily spikes your income and triggers the clawback. The smarter approach is to spread those gains over multiple years, staying below the threshold each time. This requires planning. You cannot always control when a gain occurs, but where you have flexibility, timing matters. Let me put all of this together with a real example. Take Robert. He is 73. He receives CPP of $9,000 a year. His OAS is about $8,600. He has a RRIF that is generating mandatory withdrawals of $65,000 this year. He also has a non-registered investment account that paid him $14,000 in dividends and interest. Total income, $96,600. He is $6,600 above the clawback threshold. He will lose about $990 of OAS this year. If Robert had been advised 10 years ago to start drawing down his RRSP during that low income window between 65 and 71, his RIF would be smaller today. If his mandatory withdrawals were $10,000 lower, he would be under the threshold entirely. His OAS would be intact. That is a difference of almost $1,000 a year, and it compounds over every remaining year of his retirement. That is the cost of not knowing. Here is what I want you to do right now. Step 1. Calculate your approximate net income for this year. Add up your CPP, OAS, any pension income, RRIF or RRSP withdrawals, rental income, investment income, and any employment income. Step 2. If that number is anywhere near $90,000 within $20,000, you are in planning territory. This is not an emergency. It is a signal to act. Step 3. Review your TFSA contribution room at My CRA account and consider moving investment income inside the TFSA. Step 4. If you are married, look at whether pension income splitting is being applied on your tax return. Step 5. If you are under 71 and have a significant RRSP or RRIF balance, speak with a fee-only financial advisor about a voluntary drawdown strategy. None of these steps are complicated. Every single one of them is legal, and together they can preserve thousands of dollars of OAS income every single year. If this video helped you understand something about your own situation, please share it with someone you know who is approaching or already in retirement. The clawback is one of those things that is almost never explained clearly until it is already happening, and by then the easiest solutions are no longer available. I am Grace Donovan. I will see you in the next video.